Should you use a buffer ETF if you're concerned about a stock market pullback? Like many things on Wall Street, they are always trying to come up with ideas on how to protect people in down markets that still offer good returns. While it sounds nice, many of these products produce lackluster results in the long term and generate more fees for Wall Street. Brokers selling on fear will talk about the upside of how this may allow you to sleep at night knowing if the market falls, you are protected. There's about $70 billion spread throughout almost 360 funds that are considered buffer ETFs, with fees averaging about 0.8% and that could be as high as 1%. Think about if the advisor you use is also charging a 1% management fee. Your total fees are now 2%. There are three basic buffer ETFs, a 10% buffer, 12%, and then 20%. As an example, if you had the 10% buffer ETF and the market dropped by 22%, you would only have a negative return of 12%. But it also works on the opposite side to where if the market went up 22%, your gain would only be 12%. People may want to invest in these because of emotions, which is never good when it comes to investing. The thing they are missing out on is the huge compounding effect. When you have a 20 to 25% gain, it can really boost your portfolio returns. If your portfolio is being managed to avoid high risk in investments, you will probably do much better because of compounding. The other concern I have is as these funds become bigger and bigger, they use put and call options on the S&P 500. This is a very big market, but throughout history, we have seen times where these fancy strategies using options don't always work out the way they intended. To build good long-term wealth, investors have to stop being so concerned about short-term pullbacks and instead should focus on the longer-term gains. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.